All right, good morning. Thank you very much for joining us today. My name is Maria Shiroki. I'm the Chief Operating Officer for the Alexandria Chamber of Commerce. The last 12 weeks have been unprecedented, to say the least. And here at the Alexandria Chamber, we have been working hard to get important information out to our members. We've done this through our website, through emails, and through virtual events. Since March 16th, we have hosted close to 20 events with over 600 attendees, and we're glad to add today's presentation to that list. A few housekeeping items before we get started. If you have a question, please feel free to type it in the chat box at any time during today's presentation, and Craig Browning from KWC will help us moderate the Q&A session sometimes during the presentation and then also at the end. With that, it's now my pleasure to introduce Connie Hamill from KWC Certified Public Accountants. Connie is a principal at KWC with more than 10 years of experience providing tax planning and preparation, business consulting, estate and trust, and financial statement compilation and review services. Connie works with closely held businesses and their owners in a variety of industries, providing compliance and advisory services on a range of issues that impact this segment. Without further ado, please join me in welcoming Connie Hamill to talk about PPP loan forgiveness. Connie.
Thank you, Maria. Good morning, everybody. This has been definitely a wild time in the economy, and unfortunately, things just keep on changing. I was telling Maria this morning that the Senate passed a bill last night at 7 o'clock, so I'd come in here and change all my slides. But what I hope you'll get out of this today is some clarity around how the mechanics of this are going to work, understanding that there are some things that still need to be ironed out. I believe there's still 3 bills that are active in the House and Senate that will have some impact on this program. But we got to keep chugging along here, as many people are already significantly through their 8-week period, which is now 24 weeks as of last night. And so we really need to get our hands around what this is. And so if you happen to be part of our client or referral base who attended our seminar last week on this subject, we'll see I've modified the title from being not 85% there, which is where I felt like we were last week, to being about 91% there, in my humble opinion, as of last night. So a little bit about myself. I've been with KWC since I graduated from college. I went to High Point University. I'm a principal and I run our client advisory services group, which is my passion. It's what we do is we design cloud-based accounting systems for our clients that efficiently and effectively provide data that is critical to the running of your businesses and your goals, whatever that might be. Our team provides fully outsourced accounting services and CFO solutions in a cloud-based environment. When I'm not working, I enjoy spending time with my husband, our kids, and our dogs, and there's been a lot of that lately, a lot of together time, as I'm sure you all are as well. So let's dive right in. Last night, the Senate passed H.R. 7010, which is the PPP Flexibility Act of 2020. And so the highlights of this are that the 8-week covered period has been extended to 24 weeks. And this was one of the big things, is people just felt like they weren't able to get enough motion forward to use the money in the 8 weeks. And so we now have 24 weeks. It also extends the rehire date from June 30th to December 31st of 2020. So if you were thinking that you might need that exemption for the FTE count, that date has now been extended to December 31st. It also allows employers, so let me back up on this one. Under the original CARES Act, if you got PPP money, you were not able to defer your employer payroll taxes after you received loan forgiveness. So if you were taking advantage of the deferral of payroll taxes and were planning on doing it up until the point that your loan was forgiven, that exemption has been lifted, or that exclusion has been lifted. And so you are now able to defer your payroll taxes all the way through the end of the year, even if you receive loan forgiveness. And finally, this is the big one, and this is what it'll be interesting to see where this one lands, but it changes the requirement to spend 75% on payroll down to 60%. Big warning here, and I couldn't make this any larger and still fit it on my slides, is the way that this bill is written. If you don't spend 60% on payroll, your entire loan will have to be repaid. It doesn't matter if you spent 58.5% on payroll and then 42% on qualified other expenses. Doesn't matter. If you don't hit that 60% mark, your whole loan is going to have to be repaid. And so that is really important to understand. I don't know if that's going to survive all of the legislation that's out there, because that is definitely not how the original act was written. You know, the original act reduced your forgiveness if you didn't hit the 75% in payroll, but it wasn't a cliff. This is a cliff. And so something that you really need to be aware of when you're doing your planning for how you're going to use your funds. So those are the highlights. Like, this bill is only 10 pages long, which compared to the thousands of pages that have come out in the last 8 weeks was kind of a nice break. But there's still more out there. That's just the highlights of what came through last night. So for today, the couple of things that I wanted to focus on to try to give you all some framework for preparing yourself for this loan forgiveness process. I'm going to go through a few process updates, review some clarifications that have been released in the month of May, and then review the forgiveness application itself. And I'm not going to spend a ton of time on that, because the one thing we know for sure is this is not the final application. I mean, just based on what went through last night. But we can at least talk through some of the mechanics, and I have a template that I wanted to show you of how we believe you need to go about collecting the data to really understand where you're going to be from a forgiveness perspective. So on a process related note, there was not a significant amount of change that was included in the interim final ruling that was released on May 22nd. The thing that makes me chuckle is, the CARES Act itself was put together in about a week. And since then, there have been 9 interim final rulings released and 48 frequently asked questions, which just goes to show how many holes there were in an act that was put together in a week. The main things that I took out of it is that the burden of proof for this entire exercise is 100% on you as the borrower. The language in the interim final ruling, which had to do with a borrower's responsibility in this process, was that you are to provide an accurate calculation of loan forgiveness. It is the responsibility of the borrower, and the borrower is attesting to the accuracy of what is being reported. So, the obvious question to me is, since the beginning of this process, there have been over 4.4 million unique loans granted under this program. And so from a review perspective and an analysis perspective on the banks and the SBA, how are they even going to begin tackling this? Is there going to be a lottery system? Are they going to look for red flags and focus on those? We already know that anything over $2 million is being audited, but that's a fraction of the loans that have been put out there. I think it is less than 5%. And so it'll be interesting to see what that process ends up looking like. A couple of borrower questions that were included in this IFR that I thought were interesting is, will I have the opportunity to respond to questions under review? And the answer is yes. So it is going to be a communicative process. It's not just going to be accepted or rejected, and that's that. And if they do reject your loan forgiveness application, there is going to be an appeals process. And so if you don't agree with their findings, there is going to be an avenue that you can pursue. I don't know what it looks like yet, but it's out there. So on the other side of this equation, so those are the things that I thought were interesting from a borrower's perspective. From the lender's perspective, the burden is not nearly as heavy. Their burden is that they are expected to perform a good faith review in a reasonable time of the calculation and supporting documents And there was a line in there that said that if you received information from a third-party payroll provider that you didn't, it didn't require scrutiny. And so, if you think of, where they're coming from on this is, again, there's 4.4 million loans out there that they are going to have to be the first line of review on to determine whether or not the forgiveness application and the calculations are even correct. And so it's going to be a really hard exercise, and it'll be interesting to see how that all works out. One thing that was not clear in anything that has come out to date and was somewhat clarified last night is that when do you have to apply for forgiveness? There was nothing anywhere that said, after your 8-week period was up, you have 2 months or another 8 weeks or whatever it was. But the HR 7010 that came out last night said that if a borrower does not apply for forgiveness within 10 months of the last day of the covered period, you must begin to make principal and interest payments. That is the most specific information that I've seen so far about when do you have to have this application in. It's still not incredibly concise, and you have X number of days, because you still have to get through the SBA review process and all of that. And so I think there will be some more specifics about this depending on the institution that you got your loan through. I've already started seeing some clients receiving communications from their banks saying, we're going to use this portal, or this, since your loan date was on April 10th, we expect your application to be in by this date. So I think there's going to be some institution by institution requirements as to when those applications need to start being submitted. Okay. So moving on to, there were some concepts that were introduced in the application that had been very vague or just not explicitly mentioned at all in all of the information that came out prior to the application for forgiveness itself. And so I want to go over some of those concepts because they're pretty important. The first one is the idea of an alternative payroll covered period. Now, when this act initially went into place, it was 8 weeks, starting on the day you got your money, running for 56 days and stopping. That was the period of time that you were working with. So the alternative payroll covered period, which is a mouthful, is only available if you have a weekly or bi-weekly pay cycle. So if you have a semi-monthly, monthly, or otherwise, in terms of longer, this is not an option that is available to you. And so what you're electing here is that you are choosing to slide your 8-week period to begin on the first day of the first pay period following the receipt of your funds. And so what that's allowing you to do is to match up your 8-week period, which again is now 24-week period, with your payroll cycle. Okay. Now, one thing to note here, and it's amusing to me because nothing about this has been easy, is that this concept, they say, was added to the application for forgiveness for administrative convenience. And I think that's hilarious because this alternative covered payroll period does not apply to non-payroll costs. And so what you're doing then, if you choose this payroll covered period, is you've now given yourself 2 different covered periods in which you're applying for your loan forgiveness, because for all of the non-payroll costs, your 8-week or your covered period still starts on the day you got the money. So that's something important to know if you're pursuing this alternative payroll covered period, is that it does not apply to the non-payroll costs. Okay. Another concept that was introduced, because it was not defined anywhere in the Act itself or any of the questions that came after that, is what is an FTE? Now, the general consensus prior to this application for forgiveness being issued was that it would be 30 hours. And the 30 hours is coming from just what is recognized in the rest of the universe as being a full-time employee. If you look at the requirements for the ACA, if you look at what SHRM says, they use 30 hours as a benchmark for a full-time equivalent. And so the general consensus in the industry was, of course, they're going to use 30 hours. Well, they didn't. So the page 7 of the application clearly states that it's going to be 40 hours for a full-time equivalent rounded to the nearest 10th. I have not heard a lot of conversation around this piece. There's things that people are very up in arms about, the 8 to the 24 weeks, the tax deductibility, those type of things. I have not heard a lot around this. I think people are just kind of accepting it for what it is. So when you're doing your math for your full-time equivalencies, you need to be using 40 hours. Now, they do offer what is called a simplified calculation, where you either have a full-time equivalent and it's a 1, or anything less than that is a 0.5. Okay, so why might you want to use this? Well, if you are a restaurant or a retail industry that has a lot of people that are working maybe 10 to 15 hours a week, and not too many people working 40 hours or more, you may actually get a better answer on your full-time equivalency calculation by using the simplified method, because you're taking all of those people that are working 15 hours a week and making them a 0.5. And so, when you add everybody together, that may end up making a difference for you. And so something to consider when you're thinking about this, if it might be helpful for you. Another area that had a lot of questions around it was, what is incurred and paid? When the act came out, there was not any real concrete guidance as to what that meant. So true to form, there are 2 different definitions for incurred and paid, depending on whether you're talking about your payroll costs or your non-payroll costs. So when we're talking about incurred and paid in a payroll cost environment, it means that is incurred on the day the employee's pay is earned. So the day that the employee works is the day that those costs are incurred to you as the employer. If you have somebody on furlough, then it is what does that pay represent? If you're paying them once every 2 weeks, you take the 2 weeks, you divide it by what you paid them, and that's how it is earned or incurred for this process. Now they're defining paid as the date that the paychecks are distributed, or that if you're using a third-party provider, the day that the funds are escrowed from your account. Okay. Now, one thing that was added into the application for forgiveness was that if you incur the costs and you pay them by your next pay date, then they are also includable. So if you think about it, you've got an opportunity here where you're going to end up with more than the 8 weeks or the 24 weeks of payroll, depending on where your pay cycles fall. So again, it's incurred and paid. And so if I got my money on Monday and had a payroll on Tuesday, well, I paid it in my time frame. So I can include that, even though it represents earnings prior to my 8-week period. So then I pay my couple of payrolls during my week period. But let's just say that my last payroll has 3 days of people working before my covered period ends, 5 days after, and then I pay it. Well, the way this is written, you would also get to include the 3 days that were earned within your covered period, even though they weren't paid until the next pay date. And so you have a situation where you could very well end up with more than 8 or 24 weeks of payroll being covered. And so that's a benefit to a borrower to make sure to try to plan that out correctly. Now, the flip side of this, one of the questions that we have gotten a lot is, can I use my PPP money to pay my 2019 retirement plan contribution? A lot of companies don't end up paying that until September each year. And so because it was not earned based on earnings in the period, it appears that the thinking heads think that you cannot use it to pay that 2019 contribution. You can pay it on wages that are earned inside your covered period. Now, that has not been explicitly said anywhere. These are all inferences based on the frequently asked questions that are coming out and some of the wording around this incurred and paid concept. So there's also something like 30 frequently asked questions that are supposed to be published here any day now by the SBA Treasury. And so we're hoping that there are examples for us to start digesting in these 30 frequently asked questions. Now, as I mentioned, there's a different definition of incurred and paid for non-payroll costs. And so when you're looking at your non-payroll costs, they're forgivable if you became liable for the expense and paid it by the next regular due date, or the obligation is paid within the 8-week period. So based on this definition, because one of the questions was, well, we didn't know what was going to happen, and so we didn't pay our rent on April 1st. Can I use my PPP money to pay my April rent if I didn't get my money till the end of April? Well, based on this definition, you can. And so you can, because the other question that came up is utility bills, right? If I have a utility bill with a meter reading, can I pay that and have it count? So the answer is yes. The only thing that is explicitly listed that you cannot prepay is mortgage interest. And so if you have an entity that has a building with a mortgage in it, you cannot prepay that and have it count for PPP forgiveness. So just something to note. The other thing that came out in this application is, which was a question before, is reduction ordering. So the way the original act was written, it had reductions for if you had less than if you cut somebody's pay by more than 25%, or you cut your head count and didn't restore it. And so what was unclear in the legislation was, how do you order those? Or are you getting penalized twice on the same dollar if you cut by more than 25% and had a headcount reduction? And so what the application showed us is that there's an ordering to how these things are applied. So the first reduction is applied to your entire bucket of costs, and that reduction is if you decrease salaries by more than 25%. Okay? And so if you do have that, your whole bucket of costs is going to be reduced by that to come. And let me preface this. We're going to go through an example. So just kind of listen now to understand the concept, and then we'll go into detail. That first reduction gets you to what's called your modified eligible costs. And those costs are what the FTE reduction is applied to. And so it gave us the order in which to apply these things if they were going to apply to our situation. Now, the overall scope is that the amount that you're going to have forgiven is the lesser of the amount of PPP money you received, the total cost that you have eligible for forgiveness, or your payroll cost divided by what is now 60%. Okay, and so when you look at the application, that's what this whole exercise is getting to, is identifying these three numbers, and then you have forgiveness of whatever the smallest number is. Okay. And finally, this area I think will change, and I had to completely work up my slide here because the owner's compensation has been an area where we've gotten a lot of questions. And right now, the way it reads is, and I've tried to adjust this for the 24-week period, is that owners are capped at an annualized salary or an annualized amount of $100,000. And that is inclusive of payroll, retirement, and health insurance. At one point in time, people were reading that as just capping compensation. However, when the application came out, it was clear that that was not the case. So this is an area I think we may see some change before all said and done, but I wanted to at least put this out there for thought. Okay. All right. So jumping into the application itself, like I mentioned, I'm not going to spend a lot of time on this because it's going to change. What we have now is not reflective of the bill that was passed in the Senate yesterday, and there's other stuff out there that is possibly going to impact this as well. So I'm going to briefly run through the structure of the application and then jump into an example so we can kind of see what all of this looks like in motion. So if you haven't looked at it already, the format is, it's an 11-page document and most of it is narrative. It's a lot of instructions, a lot of certifications, and really the bottom line is there's no way that you can use this one document to complete the application. There's a lot of background data that's going to have to be collected and analyzed just to fill out the application itself. And so while there are some worksheets provided within the application, they're completely insufficient to actually do the work. And so just know that you're going to have schedules and data collected outside of this 11-page document to properly complete this application. So pages 1 and 2 are line by line instructions. Page 3 is where the application actually starts, and that's pages 3 and 4. Page 3 is all the numbers, and page 4 is all the certifications. Page 5 is instructions for a schedule. And then 7 and 8 are instructions for the schedule worksheet. And then there's the worksheet. And then finally, at the end, there's documentation requirements. And so if you're curious to know what you might be asked to provide in terms of support, you will find it on that particular page. Now, one thing to note is there's not a lot that actually has to be submitted with the application itself in terms of support documents. You know, they're going to ask for your 941s, they're going to ask for some other payroll filings, but they're not going to ask for a lot. But it does say that you have to be prepared to provide any documentation you use to fill out this application for 6 years. So that is the amount of time that the SBA has to review and come back and ask you questions about your application. So that's just something to note, that it does need to be treated somewhat as a perm file item until that 6-year window is up. So with many things like this, you really have to start at the back and work towards the front. You know, you have to go through the exercise of collecting the data on the worksheets and doing Schedule A before you can get to the point where you can actually complete the application. So the purpose of the worksheet is to assist you with calculating the potential FTE and salary reductions. You know, but as I said before, you're going to have to create schedules outside of this worksheet in order to come up with the data you're needing. It's just not sufficient. And something very important to note is these are employee by employee calculations. You cannot take your employee bucket as a whole and look at it. You have to look at each individual person in your employ to do these calculations. Now, the worksheets themselves, as you can see, you look at this, you go, oh, that looks pretty easy. I can, you know, not a problem. But just wait. So the first table is for anybody that you employed who made less than $100,000 in 2019. Now, the reason that this is important is that the SBA Treasury has decided that basically if you have somebody that made more than $100,000 in a year, we don't care how much you reduce their salary. You know, they were making enough money, they should be able to fend for themselves. You know, they don't. So that's just their decision on that. And so they're really only worried about people who made less than $100,000 a year for the reduction in wages and salaries. Okay, so table 1 only has people in it that made less than $100,000 last year, or were not employed by you in 2019. So if you have somebody that you employed in February of this year, you would include them in the first table. And the reason for that is that the way the calculation runs for the salary reduction is going to be comparing to the first quarter of 2020. And so you need to have them in there in order to make sure that they're still meeting these requirements. The second table is for anybody who made more than $100,000 in 2019. And what you'll notice is that the last column is missing, right? The salary and hourly wage reduction column. Again, because if that person made over $100,000 a year, we don't care how much you reduce their salary. It doesn't matter. All we care about is what did they make and whether they were an FTE, what their FTE count is. And so that's the difference between these two tables. If you had somebody that lived outside of the United States, they would also be in this table because they will count for your head count. Okay. So what are we trying to get from all of this? Why is this important? Well, there's a couple of things that we need to know to properly complete the application. We need to know if an employee earned less than $100,000 in 2019, was their pay reduced by more than 25%? That's what we're trying to find out. And if they did, if we did reduce their pay, did it recover to at least 75% by December 31, 2020? And then finally, what was our head count? Those are the three questions that we're trying to answer here, okay? So internally at KWC, we've developed a tool that we're using to help our clients figure this out because as I've mentioned, the 11-page document is not sufficient to do this. And so what I'm going to share with you here is, let's see, it says I'm sharing, okay. So what you'll see here is a spreadsheet, okay? And if you look along the bottom, you'll see all of these tabs. There's blue ones, there's green ones, there's orange ones, okay? Each different color represents kind of a piece of this pie that you have to put together in order to properly figure out your answer, okay? So let's start with the orange ones because those are easy, all right? So the orange ones are your actual costs. What did you actually incur during this 8-week period? So let's start with non-payroll, because again, that's the easy part. So from a non-payroll perspective, we have utilities, we have rent and leased property, and we have mortgage and interest payments. Those are the three non-payroll costs that we're actually looking at. And so within the utilities, one thing that came up in this past week is that some of the thinking heads feel like you can use this transportation category for gas on business vehicles. I've only seen that in one place, so I'm still looking a little harder at that one. But otherwise, your regular utility costs are what you're looking at here. Your electricity, your gas, water, telephone, internet access, etc. From a rent and leased property perspective, you're not only looking at office buildings, but you're also looking at equipment and other tangible property. So if you are leasing copiers, if you're leasing postage equipment, anything like that, you can include that in your rent and leased property category. And finally, if you have a mortgage on a building or other real estate, you can include the interest here, but again, you cannot include prepaid interest. And this is the one area that has been explicitly addressed in the legislation. Okay, so that one's pretty easy. That one is not, there's not a lot of gray areas there, okay? So then you jump into the payroll costs, okay? And things start to get a little bit more tricky, all right? So the way we've built this calculator is addressing the fact that you have to know whether your employee had compensation of greater than $100,000 in a prior year, what did they actually get paid during the covered period, if they have any sick or FMLA leave. Now, this is not something that I covered much in this presentation, but if you are paying employees under the Families First Coronavirus Relief Act, I think is the acronym, If you are using the expanded benefits under that program, those wages do not qualify for PPP forgiveness. And so you have to subtract those from your wages when you're doing that calculation. And so it's coming up with an eligible compensation figure. All right. Now, the mathematics of this is you have to limit the compensation to $100,000 annualized. And so in my situation, both of my employees are under that amount, but this is, and I'm going to use the 8-week numbers because this bill that passed last night has not gotten enough FAQs out and that kind of thing to make me feel 100% confident otherwise. So this is all under the 8-week period, was not to exceed $15,385, right? It's $100,000 divided by 52 times 8 is the maximum amount of compensation that you could have for forgiveness, okay? And so we're taking that into consideration as well. Beyond cash compensation, you also have to look at your group health costs, your health insurance, your dental insurance, your vision insurance. You cannot include the owner's costs or employee contributions. So if you have, the reason I structured it this way is ease, okay? To say, all right, I have this health insurance bill for $5,000. And I know from looking at my payroll report that my employees deferred $1,000. And so it's backing into what you can actually use for forgiveness for this type of cost. The same goes with retirement plans. If you have a 401k plan, a cash balance plan, profit sharing, those can be included here. A simple IRA, if that's what you're doing, you take your bills for these period and you back out what was employee withholding and whatnot. And then finally, what the last bit of the payroll bucket is state taxes. If you are paying, and by state taxes, I mean employer level state taxes. So this is state unemployment taxes. If you have a location in DC and you're paying DC pay family leave, that counts. But these are entity level state obligations. So it does not include your employees' obligations, okay? And so adding all of those things together gives you two things that are important. One, your total eligible payroll costs for your period, but it also gives you the ability to fill out lines 1, 4, 6, 7, 8, and 9 of Schedule A. You know, and those parts of Schedule A are asking for, what did you pay people under $100,000? What did you pay people above $100,000? And what were your health insurance, retirement plan, and state obligations? And what did you pay your owners? So this one spreadsheet is giving you 6 answers, but you can see that you really have to dive in and look at each component to be able to come up with those answers. Now, I know there's a lot happening here, and I think that one thing people are finding is this is way more complicated than people were thinking. And so some of these bills are trying to simplify some of these things. But the bottom line is, in order to be able to figure out, you know, the caps on what you're paying people, the head counts, you do have to go through all of these machinations to figure it out. And like I said, this is the easy part, you know, coming up with what were my actual costs that I paid during this period of time. The thing that is complicated is when we're starting to get into the calculations around the reductions, okay? And so there's 2 reductions. There's, did I cut anybody's pay by more than 25%? And did I reduce my head count, okay? So let's start with the employee salary reduction. And so again, this does not include anybody who made $100,000 or more in 2019. If they made $100,001, you can throw them out of this calculation, okay? So it's under $100,000, all right? So the way the original bill was written is you were supposed to compare what you paid these people in an 8-week period against what you paid them last quarter. Well, just basic mathematics says you're putting yourself in a hole there, right? Because you've got 8 weeks and you've got 12 weeks, and that's a problem, okay? And so when this application came out, it clarified that you have to take what you paid people in the last calendar quarter, annualize it, take what you paid them in the covered period and annualize it, so that you are then comparing apples to apples, right? You're comparing two annualized periods, okay? And so when you have those two periods, now you can look at them and say, did I cut this person's pay by more than 25%? That's what we're trying to do here, okay? And so if you didn't, if they had a reduction, no reduction at all, or their reduction was 24.5%, then you're fine. But you do have to go through and do this analysis for every employee that you have during this period of time, okay? So let's say, so for my employee Susan Apple, she did not have any change in her pay on an annualized basis. In the last calendar quarter, her annualized pay was $26,000, and what I paid her during my covered period was also annualized to $26,000. No problem, no reduction, okay? But John, who's my business owner, he had annualized comp of $90,000 for the first quarter, and he only had annualized compensation of $39,000 for my covered period. So I've got a problem here because I've reduced him by more than 25%. And so then the second step of this calculation is, okay, I reduced his pay during my covered period, but did I get it back up to the higher number before the safe harbor, which right now is June 30th? Okay, and so then I have to look and say, what did I pay him on February 15th? What did I pay him when coronavirus hit on an annualized basis? And did I get his pay back up by June 30th? All right. And so in my scenario, the answer is no. I was not able to restore his pay. And so I have a reduction of $4,000 in my forgiveness amount because I wasn't able to get his pay back up. Now, where this $4,000 number is coming from is it's taking the annualized amount that you had, the 90,000, okay, comparing it to the annualized amount between February 15th and April 26th and coming up with your shortfall. It is then taking that number, dividing it by 52, and multiplying it by 8. And so it's taking the reduction of your annualized figure and narrowing it down to an 8-week period, because again, we're trying to stay in this covered period. What is the impact on the covered period? So you have to go through this exercise for every single person. And so if you didn't modify people's wages, if everybody was paid the same, then this is not going to be a problem for you. If you had people where you were changing pay and having to adjust things, as long as you did not adjust more than 25%, you will also be fine, okay? Where you're going to run into trouble is if you reduced people's pay by more than 25% and we're not able to get it back up by June 30th. Okay, and I'm using June 30th because those were the dates that have been established so far. These dates are going to change, but the concepts will remain the same. Okay, and so as you go through this exercise for each of your employees, you will come up with what is my total reduction based on employee wages. Okay. You can see, I'm sure by now, how the SBA loan application is not sufficient to do all of this work. So the second thing that you have to look at is the full-time equivalencies, okay? So this is a calculation that is comparing multiple periods, all right? And the good news about this is that as a borrower, you are allowed to choose the period of time that benefits you the most, okay, within these options, all right? So the first thing that you have to establish, though, is what was my FTE count during this covered period? Okay, that's the first thing you need to figure out, all right? So we've gone through and we've looked at the pay periods that were included in our covered period, and how many hours our employees worked. Because remember, we're working off a 40-hour-a-week full-time equivalency definition by the SBA and Treasury. And so what we've done is tried to do this in a way that is also giving you the alternative count. Remember we talked about at the very beginning, you could choose a simplified method of either 1 or 0.5, or you can use the actual math depending on which works better for you. So you have to look at your 8-week period and say, what were my FTEs during this 8-week period based on the 40 hours a week full-time equivalency? And that's going to give you a head count. All right. And so in my example here, we have a full-time equivalent under the regular count, which is using whatever fraction of time that they worked of 1.48. And we have a simplified method of 1.5 because my employee Susan was a little bit less than full-time or part-time, 50%. Okay. So from there, I've established my benchmark. Okay, that is my benchmark of what I need to be at June 30th. Pausing, I got myself confused here, as happens with this. So also just apologize. My tabs disappeared on my computer. So what else we have to do is we have to look at 2 look back periods, okay? We have to look and see what our FTEs were from February 15th to June 30th of 2019. And we have to look at what our FTE count was from January 1st to February 29th of 2020, okay? And so the reason that these are important is because they're assuming that your February 15th to June 30, 19th period would be similar to what you would expect February 15th to June 30th of 2020, okay? Now, obviously, if you're on a big growth path or the opposite, that's not gonna be true for you, which is why they've also included January 1st to February 29th. So if you hired a whole bunch of people in the beginning of the year or let people go, you know, that's being taken into consideration. And so the goal here is to end up with an equation as close to 1 as possible. All right. And so it's saying, so in my example, here are the results of my FTE calculation. Now, I will say, if you choose the alternative method of calculating, you have to use that method for all of the periods. You can't say, well, the alternative method was better for my covered period, but the regular calculation is better for my look back period. So I'm going to put those together. They don't let you do that. And so you have to choose one or the other, which is why we're looking at both of them. But again, the idea is to get as close to 1 as possible, because if you have less employees in your covered period than you did in these look back periods, you're going to have a reduction, because basically you're saying I've got 80% of the workforce that I did have in these covered periods. So again, you're trying to get to 1. All right. And so if your FTEs in your covered period are greater than or equal to either of your look backs, you're fine. You're done. You don't have a reduction on your FTEs. However, if that's not the case, if you do have a reduction, you get to step down to this next test, which is, did I get my head count back up by June 30th? Or I guess in this case, it's now December 31st. Okay, so that's the second question you ask yourself. If the answer is yes, then you're done. Okay, you achieved the safe harbor, and that's the end. You don't have to reduce anything for FTEs. However, if that question is also no, that you did not get your FTEs back up, then you're going to have a reduction, and that's going to give you the quotient that you are reducing. So in my example, I don't have a reduction based on head count. Okay, so this is 0. All right, and we'll come back to that in a minute. And so now that I have laid out all of these variables, I have my non-payroll costs, I have my payroll costs that I actually incurred, I've established whether or not I have a reduction in salary more than 25%, I've established whether or not I have a reduction based on FTEs. Now I can calculate actually how much of my loan is going to be forgiven, okay? And so in our example, on this summary page, what we've done, and again, you'll see that there's these application lines because we're trying to answer the question, right? So I've got $11,000 of eligible payroll costs. It was my payroll, my retirement plan, my health insurance, etc. I have no mortgage interest. I did have some rent. I did have some utilities. If you remember when we did our 25% test, I did have some reduction based on salaries and wages because of what I was paying John. And so I have modified eligible costs of $11,000. So even though I spent $16,000, I'm only going to have 11,000 that are forgivable because I did not pay John enough. All right. So then what it's doing is it's looking and finding, because you remember at the beginning, we said it's going to be the lesser of how much did you get? And in my example, I got $25,000. How much of your eligible payroll cost or your total eligible cost, which I have 11,000, or 60% divided by your payroll. Okay. And so that's what we're trying to accomplish here. So based on the mathematics, I'm going to have loan forgiveness of $11,190. Now, we've been really preaching to our clients how important it is to be planning this out. And the reason for that is that, in my opinion, one of the worst things that can happen is you get to the point of doing the application to find out you didn't do it right. And you now have loan forgiveness that you weren't expecting. You were expecting that your full loan was going to be forgiven, but oh shoot, I didn't meet this test and now I have a reduction issue that I wasn't planning on. And so it's really critical to be doing this exercise now and not just when you go to do the actual application for forgiveness at the end. Because what you could do is you could look at this and say, well, shoot, I don't like that answer. How can I change this? Okay, well, John, my owner, is, or my highly compensated employee, has stuck with me through this, and I really appreciate that. And so I'm going to give him a bonus here in this last pay period because he's really earned it, and the bonus I've chosen still is going to keep him at the eligible amount, so I'm not paying him over what's eligible, which you can. I mean, there's nothing wrong with that, but I'm trying to plan how I'm going to use my money. And so I'm going to give him a bonus that gets him up to the maximum forgivable amount per employee. So now what that does is if we go look at our salary tab, because I increased the amount he was paid during the covered period, I got rid of this 25% reduction. So all of his compensation is now forgivable. Whereas before I had a $4,300 reduction in what I was going to have forgiven. And the double benefit of that is now I've spent all of my money. It's all going to be forgiven because I used it appropriately and got back out of that the reduction in my salaries. And so now I only have $50 that I didn't spend that I need to give back. And so with a little bit of planning, you can really maximize how you're going to spend this money. Or if your situation is what it is and we just need to know what we're looking at, that's important too. And so understanding what that piece is, because if we didn't do this, just knock him back down here to 1,500. And I end up in a situation where I've got $13,000, $14,000 that I'm going to have to pay back to my lender. That's not the end of the world. If you're looking at using that as operative money, you've essentially just got pretty low cost financing to help you move along. And so then you're looking at, okay, I've got a 1% loan for the next 2 years, which is apparently now 5 years as of last night. So that's $581 a month that I need to figure into my cash flow planning to pay this thing back. So there's a big conversation here that needs to be had. It's more than just filling out the papers. It's really understanding how all of these pieces are working together and how to look at them and make sure you're getting an answer you're comfortable with, changing it if you can and want to before your period is up, and then also having all of the data you need to prepare this application. This has not been meant to be scary. It's important to understand really what is going to be required to fill this thing out, and how you're going to have to go beyond the 11-page document that the SBA Treasury released in order to pull this information together. Okay, so let me just switch back to my slides here. I don't have much more because I'm pretty much out of time with you all.
I have one question
Yes.
that came in.
Okay.
So does the salaried person automatically count as a full-time equivalent?
No. So you have, even if that person is salaried, you have to look at the hours that they're working. Okay, so it can be, and I'm sorry, my computer's lost the plot here for a minute. You can still pay a person their regular salary, but maybe you reduce their hours to 30 a week. You know, that's no longer a 1 FTE, that's a 0.75 FTE. And so you do need to look at that. Okay, my computer is freaking out here. Was that the only question, Craig, as I'm trying to tame my machine?
Yeah, that's the only question.
Of course it is.
Oh, wait, I have another one.
Oh, good.
Okay, so what if you hired many people this year versus last year?
Well, so to make sure I'm understanding this question correctly.
And actually, if the person that asked that just probably can unmute themselves, I guess they can just ask it directly, because that's all I know from the question so far.
Okay. Well, there's two pieces that you're looking at here, is your FTE count and what you've paid these people. And so if you've hired a bunch of people this year, then you may want to use the 2019 FTE look back period, because it's going to give you a fraction greater than 1, right? You've hired a bunch of people this year, so your numerator is high, versus last year you didn't have as many people, so your numerator is low, giving you a fraction greater than 1. So you may want to use that as your FTE period. From a pay perspective, as long as you haven't reduced anybody in those annualized calculations by 25% or more, you're fine. And so that's some of the planning and looking that you need to do to make sure that you're choosing these periods that are most beneficial to you as a borrower.
Yeah, hi, thank you. This is Sally. We have a customer service business, so we have full and part-time team members working across the country, and they work, you know, the government designated, you touched on it, the 30 to, 30 hours plus is full-time. And we swing wildly between 30 and 40 based on what their availability is. And anyways, too much information, but we definitely have added team members. So one question is, we have team members that resign. So then in your calculation, like we've not reduced anybody's salary, we've not let anybody go, but people do leave and we have hired new people. So it's just confusing for us.
Yes, I hear you. And so one thing to know is that they did specify that if you have somebody who resigned or you fired for cause, that does not count against you. Okay. And so in that instance, you don't have to worry about that being a problem for you. And so in your situation, it sounds like if you've got 30 people are working mostly over 20 hours a week, then that regular calculation is going to give you the best answer. And so you're going to have to just run numbers and look and say, okay, well, what was the mix during that look back period? And what's the mix now? And what's giving me an answer that's better for my situation? As you can see from all the kind of hoop jumping in that spreadsheet, these are not basic, straightforward calculations. And we're hoping that third-party payroll providers are going to be helping with this. And I know a lot of them are working on building reports that will give you this information, but it's not going to be ready early enough to help with your planning. And so you do kind of have to do some digging and figure out the answers.
Thank you so much.
You're welcome. So I did manage to get my computer under control here. So just kind of two quick side items here. I did briefly mention that if you have employees who are receiving pay under the Families First expanded medical and sick leave, that those wages need to be subtracted when you're figuring out what your eligible compensation is. However, those hours do count towards your FTE count, okay? And then the final thing is what we were just talking about. If you have an employee that voluntarily resigns, is fired for cause, or they came to you and said, hey, I need to work less, or more importantly, from what people are seeing right now, if they turn down your offer for being rehired, that is not going to count against you. And so those are things to know when you're working through these FTE calculations. Now it is 11:02. I have overstayed my welcome by 2 minutes. I do see there's a couple chat questions. Craig, I'm happy to answer them if they're kind of quick. Otherwise, I'm happy to put together.
Here,
Okay, go ahead.
I'll read them aloud to you. Do
Sure.
you still have to do the hours calculation if you're self-employed in your business? In this scenario, person asking, my partner and I are self-employed, paid with K-1s in our LLC with no other employees. That's one part of the question.
Okay, so to answer that part of the question is no. If you are self-employed with no employees, then the math is going to run off of your K-1s only. It's if you have employees that you have to go through all this other stuff.
Okay. And also, if you ran out of money to spend the funds on, are they just supposed to sit in your account to be repaid immediately when the repayment period begins?
So I'm interpreting that question as if you have money left over after you've paid everything you need to pay.
I think that's what they're asking, yeah.
That's how okay. So the question is, yes, you can just give the money back at the end if you don't use it all, and there's no penalty for that. And so if you've gotten everything done that you want to get done, you've spent what you want to spend, and you have it left over, you can give it back, or you can keep it as low interest financing. So.
Okay, that's all of the ones that have been entered in the chat so far.
Okay,
oh, wait a second.
Okay.
But nothing else we can spin. Oh, wait a second. Shayna, I don't know if you can turn your audio on and ask this directly. I'm not sure what you're asking.
Hi, can you hear me?
Yeah.
Oh, thank you so much. Yeah, so I've been unclear as to if we run out of things to spend the money on that's covered, like we work from home. So the rent and the utilities are kind of tangled up. We don't have a lot of those other expenses. And so you're saying that if we run out of those qualified expenses, we can spend the money on other things, but we just know we have to repay it, or we can't spend it on anything except what's on that list.
So you need to spend it on what is on the list. And this is something that is in the word just flew right out of my head. Certifications. On the certifications, if you read those, one of the questions is knowingly spent money on things that didn't qualify.
Right.
Now, I take that to mean like the rap star who bought a luxury automobile and other things with it, as opposed to other operating business costs that people have. You know, I don't take it to mean the same thing, but that's what the certification says. And so the nice thing is that now that we have 24 weeks as of last night, you know, you may be able to get a couple more weeks out of payroll, you know, if you haven't hit the maximums yet. And so we're not just dealing with the 8-week period anymore, we're dealing with a 24-week period. And so you may have some time to spend the rest of that money.
Okay, yeah, that would be helpful. But yeah, we ran out of things to, you know, we have little business expenses, but not the rent, utilities. We were just out of things. So, okay, thank you very much. Appreciate it.
You're welcome. So my contact information is on the screen. Please feel free to reach out with questions. You know, if you are looking at all of this and just saying, oh my God, I don't even know where to start, you know, we're happy to help with these calculations, and would be happy to help, you know, discuss this with you and what the process looks like. So please do not hesitate to call or email if that is a preferred method of communication, and we'll see what we can do to help you out. You know, these are kind of weird times, and you know, if we can help get this piece through so you can get back to doing what it is you love to do, that's a win for us. So with that, I will turn it back over to Maria.
Great. Thank you. We did just get one last question that came in.
Okay.
It just says, can you comment on the difference between permissible uses and forgivable uses?
Oh, that's a difficult one. So in my humble opinion, which take it, take it for what it is, they've not asked me my opinion on much of this legislation for sure, is that there was a broad bucket of costs that they said were eligible to be forgiven, right? Nowhere in there did it say, if you pay for a new computer, that is fraud, right? That is an operating cost. You needed the computer to buy to make your business run. However, it is not forgivable because it is not payroll, utilities, etc. One of the bills that is sitting in Congress right now does have a caveat that would allow for infrastructure costs. And so then the computer will become forgivable, but that's kind of an example of what I'm talking about. If you look in the news, you'll see some really egregious examples. And I think that that's what it was intended to try to dissuade people from doing, as opposed to these minor business type costs.
Great. And now what will be the final question is, Sally's asking, are you willing to share your spreadsheet with the attendees?
Oh, Sally, please reach out to me. Let's talk about it. I'm hesitant to just send it out to the world at large, because if there's any issues that you run into, I just want to make sure you're okay with it. So,
and Connie, there's a couple of requests about that. So
okay.
I think probably the best is if people would contact either through Maria or directly to Connie to contact her.
Mm-hmm. Please do. I'd be happy to talk to you about it.
Yes, and we're happy to funnel any request to Connie, even though her contact information is right there. So with that, I'm going to close this out and say thank you so very much, Connie, for your time this morning. I think everyone found this incredibly informative. We did record it. It should be up on the Chamber's website on our COVID-19 resources page in about 2 hours or less, depending on how long it takes to download. So if you want to rewatch and take some additional notes, please feel free to do that. And with that, I'm going to say thank you again, and thank you all for joining us, and we will see you next time.
Thank you.